Through the 1880s, American railroads expanded at a pace the country had never seen. Between 1880 and 1890, the U.S. rail network grew from roughly 93,000 miles to more than 163,000 miles, much of it in the sparsely populated West and South. This expansion was financed almost entirely by bond debt, much of it sold to British and European investors who treated American railroads as the growth engine of the age. The problem was many new lines ran through territories without enough traffic to justify them. Companies had borrowed to build, but the revenues were not there to service the debt. By the early 1890s, the railroad sector was quietly drowning in obligations it could not meet. In 1890, Congress passed the Sherman Silver Purchase Act as a political compromise between Western silver mining states, which wanted unlimited coinage of silver, and Eastern creditors who wanted hard money. The law required the Treasury to purchase approximately 4.5 million ounces of silver per month, essentially the entire domestic silver output, paying for it with Treasury notes redeemable in coin. Under prevailing practice, the Treasury honored requests for gold redemption to maintain the gold standard. So the notes functioned each month as a mechanism for converting silver purchases into gold outflows from the reserve. Meanwhile, world silver prices were falling relative to gold, meaning each ounce of silver bought produced an increasing gold liability. By 1892, the Treasury's gold reserve had fallen from a comfortable cushion to a level that alarmed fiscal conservatives in Washington and in the financial markets. On February 26, 1893, the Philadelphia and Reading Railroad, one of the largest coal-carrying lines on the East Coast, declared bankruptcy. The company had overextended itself acquiring coal properties and could no longer service its bonds. The failure shook investor confidence immediately. European creditors already holding large amounts of American railroad securities began selling and repatriating capital to Europe. That capital had to be converted back into gold, which added further pressure to the Treasury's already thin reserves. The Reading's collapse was a signal, not just a single failure. The structural problems underneath the railroad boom were surfacing, and foreign capital was heading for the exit. On May 5, 1893, the National Cordage Company, a trust that had attempted to monopolize rope manufacturing, announced it could not pay its creditors and went into receivership. Its stock had been a speculative favorite, and its sudden collapse set off a selling panic across the New York Stock Exchange. Stocks fell sharply as investors rushed for exits. The panic spread from equities into the banking system as depositors, fearing that their banks held bad railroad bonds or other troubled paper lined up to withdraw their money. The chain ran from the stock market to the banks, and from the banks to the broader economy. The bank runs that followed were among the worst in American history to that point. More than 500 banks suspended operations during 1893. There was no Federal Reserve, no federal deposit insurance, and no lender of last resort authorized to inject liquidity into the system. Banks that ran short of reserves simply locked their doors. Depositors who arrived too late lost access to their savings, sometimes permanently. Businesses that depended on bank credit found their credit lines gone overnight and could not meet payrolls or pay suppliers. The disruption was nationwide, reaching farm towns in the South and West, as well as commercial centers in the Northeast. Simultaneously, the Treasury's gold reserve was approaching what officials in financial markets treated as a critical minimum, an informal threshold of roughly $100 million that had long been regarded as the floor needed to back outstanding paper currency. The combination of ongoing silver note redemptions, European capital withdrawal, and panic-driven gold hoarding pushed reserves steadily lower. Treasury Secretary John Carlisle watched the gold supply shrink week by week. The fear was that if reserves fell far enough, the government would be forced to suspend gold payments on its paper currency, which would destroy confidence in the dollar at precisely the worst moment for the economy. President Grover Cleveland, a committed hard-money Democrat who believed the Sherman Silver Purchase Act was the primary driver of the gold drain, called a special session of Congress in August 1893. He pressed lawmakers to repeal the silver purchase requirement, arguing that as long as the government was obligated to buy silver and pay out gold on demand, the Treasury would continue to hemorrhage reserves. After a bitter legislative fight that split both parties along regional lines, the repeal passed and Cleveland signed it on November 1, 1893. Western and Southern members who favored silver were furious, believing the repeal protected Eastern banking interests at the expense of farmers and debtors. The repeal did stop the monthly silver purchases, but the gold reserve had already been deeply eroded and credit throughout the economy had contracted sharply. The Depression did not end. The years 1893 through 1896 brought economic conditions that, by most measures available to historians, were severe. Estimates of unemployment during the worst years vary considerably because consistent national data did not exist in the 1890s. Economic historians have placed peak unemployment in a range roughly from 10 to 18%, with genuine uncertainty around those figures. More than 15,000 businesses failed during 1893 alone, according to contemporary accounts compiled by commercial reporting firms of the era. Farm prices collapsed, mortgage foreclosures surged across the Midwest and South, and industrial output fell sharply. In the spring of 1894, Coxey's Army, a march of unemployed workers on Washington organized by Ohio businessman Jacob Coxey, became one of the first mass protests of its kind in American history, demanding government-funded public works to relieve unemployment. By early 1895, the Treasury's gold reserve had continued to fall despite the repeal of the Sherman Act, because holders of paper currency kept presenting notes for gold redemption. In February 1895, President Cleveland struck a private arrangement with J.P. Morgan and August Belmont Jr., who represented American and European banking syndicates. Under the deal, the syndicate would provide the Treasury with approximately 3.5 million ounces of gold in exchange for government bonds, and Morgan pledged to use his firm's market influence to discourage gold from flowing out of the country through foreign exchange markets. The reserve stabilized and the immediate crisis passed. The arrangement drew sharp criticism. Many Americans found it alarming that the elected government of the United States had needed to negotiate a rescue with a private banking syndicate, and that the bankers had extracted profitable bond terms for their assistance. The episode burned itself into public memory as evidence that Wall Street held too much power over the nation's finances. The Depression of the 1890s transformed American politics. Farmers carrying fixed-rate mortgage debts and falling crop prices concluded that the gold standard was the problem, a tight money regime that kept prices low, made debts harder to service, and served creditors at the expense of debtors. The Populist Party, which had grown throughout the early 1890s, fused with the Democratic Party in 1896 around the cause of free silver, meaning the unlimited coinage of silver at a ratio of 16-1 against gold, which supporters argued would expand the money supply and raise prices. At the Democratic National Convention in Chicago on July 9, 1896, William Jennings Bryan delivered what became one of the most famous speeches in American political history. "You shall not crucify mankind upon a cross of gold," he declared. Bryan won the Democratic nomination but lost the general election to Republican William McKinley, whose campaign was backed by industrial and financial interests and who defended the gold standard. Recovery from the Depression came gradually from about 1897 onward. Several factors converged. New gold discoveries in the Klondike in 1896 and 1897, together with expanding South African gold output, increased the world gold supply and provided mild monetary expansion. Crop prices recovered partly on account of poor European harvests, and the Spanish-American War of 1898 generated additional federal spending. In 1900, Congress passed the Gold Standard Act, formally defining the dollar as a fixed weight of gold and ending the legal ambiguity about whether silver could serve as a monetary base. The act settled the monetary question that had destabilized American politics for 2 decades, though the rigidity of the gold standard would be contested again under the very different circumstances of the 1930s. The Panic of 1893 demonstrates dynamics that reappear in financial crises across different eras. Asset booms built on debt that the underlying revenues cannot service tend to unwind badly, whether the asset is a railroad, a housing portfolio, or a technology startup. Currency and monetary policy are never purely technical questions. The silver fight made plain that who controls money and what backs it are intensely political choices with clear winners and losers. And the absence of a central bank or deposit insurance meant there was no shock absorber when confidence broke. The Federal Reserve, created in 1913 partly in response to recurring banking panics, and the FDIC, created in 1933 after the Great Depression, were direct institutional responses to the kind of cascade the 1893 panic demonstrated. Understanding how those institutions were built in response to specific failures helps clarify what they are designed to do and where their limits lie.